It's the Five Stones Radio Show with your hosts, Raymond the Real Estate Monkey Modulin and Colin Hedegaard. Sit back, relax, try to survive. Here comes the Five Stones Radio Show.
Good morning and welcome. I am Raymond Modulin, aka the Real Estate Monkey, and I am just one of the hosts today. With me we have got...
I am Colin Hedegaard, the Great Dane.
And batting third in the lineup,
Joe Trester, the Real Estate Advocate.
Welcome to our new format. If you've been with us before, you know that we do a radio show and we do a podcast. We have decided to try and merge the two into one entity to better help our listeners find us in more places. So welcome to our new format. It's so new that we don't really have a name for it yet. So we're just calling it the radio show or the podcast.
That's right. And for those viewers, you'll see that we're in a bit of disarray.
Yes, so bear with us for this. But today we have decided to talk about this new government intervention or shackling, if you will, of the better credit borrowers that Fannie Mae and Freddie Mac have imposed on people with better credit scores. And I think that Colin's probably better to kind of lead this because of being with Five Stones Mortgage and understanding that field. So.
Yeah, well, it hit home in some pricing yesterday. We had a couple of clients that basically came in with the result exactly as expected and as speculated on the news over the last couple of weeks, where a good borrower with a very good debt ratio and an over 700 credit score priced 0.5% higher than a client with a double the debt. The other client's debt ratio was over 40%. And they were at 6.7%, and the 700 credit with the low debt ratio was at 7.2. So I witnessed it firsthand. And the industry has always punished people with bad credit by basically doing a loan level price adjustment and raising the rate for that person to compensate for the risk. So really, they aren't rewarding that person directly; they're just punishing them less. But they have added some fee to the high credit person. So they've kind of equalized the field, and they cross back. So the high credit person is now getting punished. The low credit person is getting punished less than they used to.
So basically what they're doing is, if you have good credit and you've been a good steward of everything, you've done what you're supposed to do, now they're saying, hey, you're going to take part of the risk of the rest of these people that are risky and not us.
Yes, ultimately it's a fee to Fannie and Freddie to subsidize the higher risk.
But for those of you that have listened to the radio show, you know that Joe and Colin and I are also in the same Bible study group. Mm-hmm. And I do believe the Bible does say that you will be thy brother's keeper. So in essence, this is what we're seeing, in that the fact that we are now, as good credit borrowers, helping the lower credit and being thy brother's keeper.
Yeah, it's a risk management thing that normally you should
is it
be
really
compensated more when you...
Is it really a risk management thing? It's not.
Well,
all they're doing is...
It's a share the wealth thing, I guess.
Well, now I agree with that. It doesn't lower the risk of a poor borrower by charging good borrowers more money. All it does is it makes us pay for those people that are defaulting, so that the lenders are actually making their money safer.
I've always made the argument that the lenders actually loan money with no risk, because Fannie Mae and Freddie Mac are government backed, and they buy these loans, and then the FHA guarantees those and the VA guarantees those. So the lenders give the loans with no risk, and then if you borrow more than the 80%, they force you to buy insurance on your own loan. So they're insured on the 20% above the 80% that the government buys.
Then what I'm hearing you're saying is we're starting a bank next week.
Well,
If I can start a business that has no risk, but yet make money, I'm all in.
well, and now what we're learning is that the government will bail you out if you F
Yeah,
up.
that's the next thing that we could talk about is the old Too Big to Fail, which was a great movie. If you've never seen Too Big to Fail, go watch it. It does give you quite a good timeline of what happened in that 2008, 9, and 2010 timeline with the banks. So yeah,
That was a good example of when the government intervenes with good intentions. 10 or 15 years after that, catastrophe happens.
Yeah.
Because what you're doing is you're messing with the natural order of things. If I'm going to take more risk, I should get paid more.
right.
I mean, that's just a fact. Now, who pays me that difference in cost? They're just changing who pays it. They're still getting paid, you're right. The risk management hasn't changed, simply who pays that risk.
Yeah, now it's being paid by somebody that's better.
But what they're doing, and it's driving our financial guy crazy, is the government is coming in and intervening, but they're also saying we're only going to bail out a bank that has a systemic risk. Well, that makes it subjective to whichever donates to the right causes or has
Well,
the right constituents.
But they've already proven that. I mean, the bank's already proven that. They let, was it Bear Stearns go under, but saved AIG. So, I mean, the government's already proven that they will select
Yes.
who they want to save. And coincidentally, AIG also holds the retirement accounts for all the Congress.
Yeah, it's a little shocking how that happened, right?
So it's
Yeah.
a little shocking that that company got saved.
So
And
that's the kind of bank we want to start, is one that they like.
yes.
And
Well, if I was involved, they would like it.
yes.
Everybody likes it.
Yeah. I come back to all of this in the last couple of weeks as this has been rolling out. I think we've noticed a lot of people that have, applied for a mortgage because they want to buy a house and have decided, well, I'm not going to buy a house now. Or people have decided they're not going to refi because they don't want to deal with that. And the reality is, we're going to be dealing with it, so not doing it for a while is not going to be beneficial. If you still want to get a house, you need to go get a house. You need to live your life.
Well,
It isn't like it's tripling your payment. We're talking about what on average?
the lender you use is not a monopoly, but basically the end product is a monopoly
Yes.
thing. So
Yeah,
you
but-
don't have a choice. You want a house and you don't have $400,000, you're going to have to get a mortgage. So guess where you go? You go to a lender that has the money.
Yeah, I mean, it's monopolized by the fact that the secondary market is driving the primary market lenders because the primary market wants to sell that loan to the secondary. And if the primary makes a loan to somebody the secondary doesn't like, they make the primary keep it. And now
Yep.
they've got all their money tied up in, all these notes that they're holding and servicing rather than offloading it to Freddie Mac or Fannie Mae, which was the problem with Too Big to Fail. When the secondary market quit buying, then all the banks all of a sudden started going under because they didn't have enough cash flow and their investors got scared. And that's what's I see is happening now, or is on the path.
That is when I say they make the loan with no risk, what I mean is, let's say I make a loan for, just for easy math, $400,000. I write that loan, I fund it with a line of credit, being the bank or the wholesale lender, whoever. The house is $500,000. The client puts in $100. I loan him $400. Fannie or Freddie buys that loan from me for probably somewhere around $420,000.
Yeah.
$430,000. I pay some of that to the salespeople, and then we keep the spread, and then I pay off my line of credit and do it again. So
Yeah.
the question is, how big of a line of credit? How many transactions can I do? And if I can make call it a 4% simple interest every 45 days, I'm actually making somewhere like 30-40% annualized just on transactions, and I only write loans that are already guaranteed to be bought. So when I run it, automated underwriting, that's Fannie Mae or Freddie Mac saying, we'll buy this loan as long as this checklist is done.
Well, see, that's the key. They're making loans that they know they can sell, and that's what I was saying. If they make a loan that can't be sold, then that underwriter has to service the loan i.e., can't pay their line of credit back because they don't have the 400 grand. Now they get 550 a month. That's where the problem is, and that's what happened in '08. So now they're making sure, all these underwriters are making sure, or loan companies are making sure they can be sold so that they don't get stuck servicing.
Yeah, so when you get a loan denied a week before closing, all of you in real estate, because you didn't provide another bank statement, that's something on the checklist that Fannie Mae, they're not willing to take the risk with their 400 grand and then have Fannie Mae say, no, we're not, you didn't dot all your I's.
Right.
So they're going to kick that back. The lender does not want to service loans. Do you think banks want to make loans? The servicing of loans is traded all the time. So you make your payments to one place and then they sell it in another place. Mm-hmm. Nobody wants to do that job, because think of the mechanism in place, escrow accounts and paying your taxes and having people process all
And
that.
phone call people.
Fannie and Freddie pay something to the tune of $12 a month for them to service your payment. Nobody wants that unless it's a sales environment where they can refinance all those. It's a lead list. So the only reason one bank might buy it for pennies on the dollar, they don't want to service it. They want to be able to call you when rates start dropping and refinance your loan.
Yeah.
They want to be the ones to churn those transactions.
Like-
and I'm using the word churn, but that's what it is. So
Like Quicken.
like Quicken, like all of them, all of the banks do
Yeah.
that. So that's why all that stuff happens
Well-
behind the scenes. But they're making loans with no risk, and it's very profitable. And then the government says, also, by the way, you have to loan it to everybody,
See, the good thing is, though, you use United Wholesale,
typically.
which
Yeah.
is only a wholesale underwriter. They have no consumer arm like Quicken.
Yeah, Quicken actually just got in trouble again. Twice in history, they have taken their wholesale clients and turned it over to their retail.
Yeah.
Because their wholesale, they're paying 200 or 300 basis points out to wholesale lenders or brokers. They would much rather do that internally with their retail people, that they cost about 80 basis points.
Yeah.
So they make another 200 basis points in profit off of that spread. So they would rather do it internally.
So they're taking their loan list and making it a sales list.
They're making it a sales list.
Whereas United doesn't do that.
But they've twice in the past taken clients I have sent them and given it to their retail, and they've called my client and said, oh,
Quicken has,
Quicken has.
not United.
United hasn't done that, at least yet, and hopefully they never will. I feel they're on the side of brokers. They actually said, if you do business with Quicken, you can't do business with us.
Yeah.
And that was very controversial. I completely understand it, because they don't want brokers, even though I like the idea of having my own choice, they think that brokers need advocacy in the world.
Well, you understand that if they take that lead list like Quicken and turn it into a retail list, and Quicken starts calling the client to refinance, they are virtually putting brokers out of business.
Yes.
And United kind of protected us by saying, if you deal with us, you can't deal with them, because we want you to protect you. Well, I remember, like you said, that was a big controversy, but the reality is they were actually looking out for the mortgage broker, because if you take your client to Quicken, Quicken's now going to start calling them directly.
And they were advocating for themselves as well.
Well-
they have chosen the target market of brokers, so they aren't going to flow with the wind like all the other lenders,
Right.
and shift their
Well,
business model.
and it is a business. They should advocate for themselves too. You're in business to make money, and there's nothing wrong with making money while you're in business.
Yeah, and as an aside, they are also right now throwing $20 to $30 million a month, basically, to brokers to give away down payment assistance. They're doing a 1% down conventional, which is actually, it's a 3% down loan. It's a Fannie and Freddie product called Home Possible.
So they can sell it.
So they can sell it. They're not keeping these loans, but they're throwing in 2% out of their own pocket, which is ultimately they're doing the loans for free on their side to keep brokers
Yeah.
moving in a slower market.
So that reminds me, if you're interested in the new 1% down, you should get a hold of Five Stones Mortgage at fivestonesmortgage.com and talk with Colin, because this is something that you use United as an underwriter, and they are throwing, like you just said, 20 to 30 million a month in helping buyers buy property. I know that we met the owner of United, and he's got like a $10 billion line of credit.
Yeah, he was adding a $10 billion.
Oh, yeah, he
so I
was
think
adding
it might have
$10 billion.
It might have been $10 billion before, and they doubled it.
Yeah, and that's what he's using to fund the loans.
Yep.
And when he sells them, he gets the money back, pays off his line of credit. So that's basically the process. When I teach this in Real University, I always tell people I'm going to burst your bubble. There is no such thing as the Easter Bunny, and banks don't have money. Banks use investors, either through a line of credit or BlackRock or Jed Clampett. And it's funny, I use the Jed Clampett TV show because it is exactly the truth.
Yes.
Mr. Drysdale kept kissing Jed Clampett's butt in every episode, and it was funny. But the truth is, it's the truth because it was Jed Clampett's $1 billion in the bank that they were loaning out, not the banks.
Well, and the reason that banks have these issues, there's a number of reasons, but one is the government has been lobbied and advocated for them to be able to loan 10 times their deposits.
Yes.
So if they have $1 billion, they can make $10 billion in loans.
Yeah, the reserve requirement's only 10%.
And then the flip side of that is they take the money that they do have, and they've been buying long-term investments. Well, now they have a duration problem. So as Mike, as our money guy knows, when people come in and ask for their money, and hell, banks have even gotten us comfortable with the fact that we can't withdraw all our money.
Yeah.
I mean, if you walk in, I just saw a guy online. He said he went in, he wanted to withdraw $250,000 to put in a pile on his podcast, which we should do. He
Let
went
me
in-
know when we have $250,000 that we can
We're
withdraw.
about 240,000 short.
But when he went into the bank, they said, "Oh, we'll get it for you, but we have to order it. It's going to be 3 to 4 weeks." Well, 5.5 weeks later, they called him and said, "Well, we got your money. You can come in and pick up $160,000. That's all we could get." He said, "You mean to tell me that you can't get me? I can't get my money today if I wanted it."
Yeah.
So he published this as a
That became the podcast.
that became the podcast, and he had a $160,000 pile. He could not get his money out of the bank, and that has evidently become acceptable.
Yeah.
Which I think that a generation or two ago would probably burn this place down.
All right. Well, that was a good section. Normally here on the radio we take a break
Yeah.
and go to commercials, but we're not going to do that now. But I will say that this next episode is brought to you by Real University.
Yay.
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 If you're looking to get your real estate license, go to realuniversity.com and check it out. We also do continuing ed for the state of Indiana, the state of Virginia, Florida, by the time you're actually probably watching this, and some new states coming up. So go to realuniversity.com and check it out and get your real estate license there.
Yes.
All right?
Look for more in the future too, right? Aren't you?
Yeah,
constantly
more
expanding?
states.
We
We're adding
are.
more states. We're adding. You've been adding title and all kinds of other
Yeah,
education. There's-
home inspection, title work. We looked at the mortgage industry, very complicated and regulated in the education. Not that we couldn't do it. We decided to,
Well, our IT guy quit. It was so difficult.
yeah. The
There's
chief
that.
technology officer.
There's that.
Mortgage is a tough.
And he quit because of the mortgage regulation rules for
Well,
education.
it is a little bit ridiculous. I'm not going to argue with
Yeah.
him on that. He accelerated retiring.
Then let's talk about now that from a prospect of the real estate side.
Yes.
Because that increased, I'm going to say increased interest rate. Colin calls it a better interest rate for worse borrowers. But that increased rate, and you mentioned, what was it, 7.25
Over
for the
7.
good borrower and 6.85.
6.75 for
Yeah.
the less.
So it was
borrower.
half a point difference for the borrower that was worse. That's going to affect then some of the high-end purchases because typically better credit borrowers buy bigger houses.
Yes.
That's the
typically.
first analogy. I mean, I know that somebody's going to email us and go, my uncle's worth $1 million, he bought $100,000. Yeah, that's true. But typically, the higher credit, high net worth, high people that have been really good buy the higher end homes. So do you think that's going to affect the higher homes? Now, like in Indiana, I would say 500,000 and above is probably a higher end home.
Yes.
California, that's a shack.
Yeah.
Well, there's an irony to this, as I actually priced the FHA for this good credit borrower as well. And the FHA came about to create, that was for the bad credit, low in down payment. That was a 3.5% down. Everybody got a good interest rate because they were collecting mortgage insurance to subsidize the failure rate. So that was designed for the bad credit borrower. That was a 1.25% lower for the good credit borrower than the conventional deal. And they've lowered the mortgage insurance.
So would United still kick in 2% on an FHA loan?
No.
So it's got to be a conventional 3%, which technically I'm going to argue that I have a problem. It's actually an insured conventional.
True. We've had this conversation before. If you got mortgage insurance, it's an insured conventional.
So it's a 97%. United kicks in 2, they put 1. But if you go FHA, it's 3.5%.
I know that you guys have things segmented on, I say you guys, real estate agents have this segmented on the purchase agreement.
Yeah.
In my world, you look at things as conventional or government, insured or uninsured. It matters not. It's just separate filters. So that's why we talk about things a little differently.
See, in our world, they say conventional is one checkbox, and then insured conventional is another separate checkbox. So if you type, and they talk to you and say it's conventional, and then the realtor puts conventional loan on it, the other side's going to go, no,
right.
That's 20% down. You meant insured conventional.
Well, insured conventional is conventional, but conventional isn't necessarily insured conventional.
By your standards.
Well, it's true in every standard.
No, it's not true in our standard.
Insured conventional is conventional.
At the risk of ending this debate, I think the thing that I am seeing that concerns me from this is we still have a real issue with having enough houses available on the market right now. And having this happen where people that are really qualified to get something else, and they now see that they're going to pay more, and they already have a low interest rate where they're at, it's going to keep people where they are and less homes going on the market yet again. It's going to stifle that into things, which is going to make it more difficult in general.
Well, you had a house under $300,000 that you sold in a day.
Yes.
They're under $300,000, which in Indiana, still, I mean, that's a pretty decent house. Indiana's got a low cost of living. Traditionally, you would get a pretty nice house, but the average family, and I say average, around here, we have a lot of families that maybe work at Amazon. Maybe both people have $20-25 an hour job, right? So they're making $80,000 as a family, $85,000. That family a year ago could afford a $350,000 house at 3%.
Yeah.
Now they can afford a $275,000 house. So when they go look at the house, housing prices haven't come down $75,000.
No.
So they go
They
look
won't.
at that. They know what they could have gotten last year if they were even looking at houses.
Yeah.
Now they're looking at these houses, and we have clients that are giving up because they're disappointed in what they see.
Well, yeah, I mean, it's the old adage. Last year I could have bought a steak for this $10, and now for this $10 I only get hamburger. So now they're disappointed.
Yep.
Well, my wife is disappointed. She has to go back to the office 2 days a week. And 4 years ago, if you said, well, we're going to let you work from home 3 days a week, she would have been elated. Now she's pissed.
Well, remind me not to email this directly to her. But, no, I just, you know, and you
why you're
mentioned,
emailing his wife.
well, this video, but
I'll ask her.
you'll ask, yeah. So, and you mentioned, I just, listed and sold a house within 1 day, but it's under $250,000, and if you look at the market right now, I mean, there isn't hardly anything $300,000 and under anywhere because people aren't moving up for the same thing you were talking about. What they can afford isn't giving them enough of a change to justify. I mean, I'm in that boat, my wife and I. We've decided we're going to do work on the house because what it would cost for us to move up is ridiculous in comparison to what we're paying right now. When I have a $900 a month mortgage, doubling that to do something that is not twice as nice just seems ridiculous.
It's the basics of economics. We have a supply shortage
Yeah.
in housing, so prices cannot go down because there's
Well-
not enough supply and there's too much demand.
I've done some in reading on the today's market versus 2008. And most of the pundits that I have read have said that is the reason that we will not end up in the 2008 scenario, because in '08 there was a huge oversupply of housing, where now there is not. So like you said, that they're not going to drop in value. Matter of fact, even though the velocity has slowed down in the number of home sales in our market, the average price has still gone up.
I think we went from a great market to a berserk market. Now we're back down to a great market. When I say great, I mean home values going up, equity building.
Yeah.
What's the average? 60 days on market. I mean, that's a good market, right?
Yeah.
Traditionally speaking,
Well-
it's not 3 days on average on the market.
No, and you, like I said, used to joke. 2 summers ago, we were measuring time in hours on the market. How many hours is it?
Yeah,
on the
laughing at
market?
each other. Oh, that didn't sell in 2 hours? You're
Yeah.
terrible.
Yeah.
Yeah.
Well, we basically had 15 years of the government intervening in such a magnitude that they disrupted everything. I mean, they printed so much money, threw it into the economy, threw people $10 trillion during COVID, and everything just really is messed up. So, in my opinion, what that historically does is create a worse crash.
Yeah.
Because things do cycle, but everybody associates oh man, housing's a problem now, rates are going up. They think, 2008, this is totally different environment. The millennial buyer group is twice the size of the baby boomers. We've talked about that. Just that pull on the market. And then they say, well, they don't want to own things. Well, a third of them do, at least a third of them, and maybe even more.
They want to own it. They can't afford to own it.
75%. The last study I said there were 25% of the millennial age group that were going to self-classify themselves as forever renters. And the number one reason was affordability. So Joe's right. So what is there, 10,000 a day turning 40 for the next 19 and a half years.
Yeah.
So figure 7,500 of those
That's a lot of houses.
are
So-
buying houses.
And I think a lot of them are seeing all this passive income ideas and things.
Yeah.
And they want to make money without working, just like the rest of us. So that
Well, and we want to go back to '08. The other side to it is they were giving loans for more than what the home value was. Like, personally, I mean, I built a house in 2006, and they gave me a check for $3,800 at the closing table.
You personally built it?
Yeah, no, I had it built. I did not personally build it. Point being, they paid me to purchase a house. So the loan was for more than what the house was worth to begin with, and we don't have that going on. And and maybe that's the silver lining to what we have going on now. We are all going to pay a little bit more, but we're protecting ourselves from an '08 style crash, even though we still see banks failing right now, but it's a different scenario.
Though it is slightly better, with Dodd-Frank and all those things, they did not ease that any. You
No.
can still get a house with 3% down, bad credit, bankruptcy, collections, debt ratio of 50%. I mean, give me a break. That person is equal to risk as that person was in 2008. So I don't buy. I mean, I think the government's subsidizing people that don't deserve to buy a house.
But they're not loaning 115% of the value of the home.
No, but they weren't in the first place. The government wasn't guaranteeing that. They were guaranteeing the same amounts they are now. The banks were taking extra risk in giving lines of credit and seconds and stuff like that, which weren't guaranteed by the government. So the banks were doing
Which is
that.
what I think he's saying. That's why the banks failed.
Yes.
I remember at one point Wells Fargo was doing 125% loan to value.
Yep.
Well, I agree.
You
But
know.
that isn't why they failed. Why they failed is because they were saying this loan is just as good as the rest of those loans that put 20% down, and they were sneaking 3 or 4 of those into the tranche of investments.
Yeah.
And the banks were fabricating the underwriting of the bond groups and then selling them off, and then somebody analyzed them, the guy on the movie,
Yeah.
said, hey, these are all actually full of crap. There's garbage snuck in here. They're all going to go down, and they did.
Yeah.
So that was the secondary market that really crashed. The government, the banks were making stupid decisions too, and giving lines of credit and whatever. But anyway, you reap what you sow, and now we're reaping.
Yeah.
We're about to reap more of what we've sown.
So it's kind of ironic, like Joe was saying, that the time has slowed down for days on the market, but the house prices are still going up.
Yep.
Over the last 4 months, according to the statistics in our local board. And I think where you were kind of going with that and you got kind of waylaid was, according to the U.S. Census Bureau, the average homemaker and the average income now cannot afford the average price of the house
Yep.
based on census statistics.
I recall you and I saying that in one of the first radios like a year ago. Do you
Yeah.
remember saying
Yes.
Yeah.
that day is approaching that the average
Yes.
family can't buy the average house?
Well, they can't. I mean,
We're there now.
you started that. I mean, you started that. You get a family that's making $100,000 a year as a family, and you know the average house in Mybor, which is our local board, was like 276. You know, so they're getting really close to not being able to afford what we're calling the average home price based on their average income.
And then you got to factor in the cost of groceries going up, the cost of fuel going up, the cost of vehicles going up, the cost of
Insurance.
school going up.
Property
Everything
taxes.
costs so. I mean, everything costs so much more.
My taxes didn't go up.
I know.
You live in the wrong county,
Yes, I do. Which is Marion County, take note.
which is all you rich people.
Well, we basically have the same house, and I pay 3 times the property taxes you do.
Yeah, about 3.8, but who's counting?
Almost 4 times.
Yeah.
I'm
All you
happy.
need to do is live in the woods,
I'm happy.
like
for
I
you.
do.
You commute, so you
I
know,
pay for. I probably make up for it in gas.
You have a gas tax unspoken.
Yeah.
But
So,
you choose to do it.
all right. Well, I think that was a good format for the first show.
I agree.
In this format, where we have combined our radio show with our podcast, we'd like to thank you for coming and look forward to more coming in this, where I think we're going to discuss more about small businesses, real estate, financing, personal financing, all of this. So make sure you click the subscribe button and the like tag or the bell tag, is that what, to get alerted. We put these out about once a week. So thank you for coming, and thank you. Thank you, sir.
Thank you, gentlemen.
Peace out.
Harumph.
I thought we were going to.